To understand the recent collapse of the Silicon Valley Bank, we have to first understand how bonds work. Welcome to Money Crafted. Now, what are bonds? Bonds are a sort of debt security that stands in for a loan from an investor to a borrower, usually a business or governmental body. Investors who buy bonds are effectively lending money to the bond's issuer, who promises to repay the loan with interest over a defined time period. The party issuing the bond will normally choose the interest rate, also known as the coupon rate, that will be paid to bondholders, as well as the bond's maturity date, or the time at which the bond's principal will be fully returned. Over the course of the bond's life, bondholders receive consistent interest payments, sometimes referred to as coupon payments, and when the bond matures, they receive its whole face value, that is, principal amount. Bonds are considered a relatively low-risk investment, as they provide a predictable stream of income and the principal is typically repaid at maturity. They are often used by investors who are seeking a steady income stream or who want to diversify their investment portfolio. Even though it is considered safer than most investment like stock, mutual funds, cryptocurrency, etc., there are still risks involving when investing in bonds, and the risks depends on the type of bonds we are investing on. There are many different types of bonds available, including government bonds, municipal bonds, corporate bonds, and high-yield bonds. The interest rates and risks associated with each type of bond can vary significantly, so it is important for investors to carefully research and consider their options before investing in bonds. Among these, we take government bonds. Government bonds are issued by the United States Treasury and backed by the full faith and credit of the United States government. They include intermediate and long-term Treasury bonds. Intermediate-term bonds mature in 3 to 10 years, whereas long-term bonds generally mature in 10 to 30 years. These bonds have one of the lowest credit risks of all bond investments, since they are supported by the full faith and credit of the United States government. A government bond does have some inflation risk, which is the possibility that its relatively smaller return will not keep up with inflation, as well as market risk if it is sold before its maturity. When interest rates increase, the issuer, example in this scenario the government, will entice investors with new bonds by offering a greater yield or interest rate. As a result, if a bondholder owns a bond with a lower interest rate than the recently issued bonds, the bond will lose investor appeal and lose value on the secondary market. This is due to the possibility that the investor could sell their bond at a loss and buy a freshly issued bond with a greater yield, which would result in a superior return on investment. The two are inversely proportional. Bonds lose value when interest rates increase. The fixed payments on old bonds also lose value when interest rates rise, since they now have a lower interest rate than freshly issued bonds. As a result, the price of current bonds decreases as investors demand a higher yield to make up for the decreased interest rate. In general, rising interest rates result in greater yields on new bonds, which depresses the value of older bonds with lower yields, since investors find them less appealing. The link between interest rates and bond prices can be complicated, and other elements like inflation, the state of the economy, and credit risk can also affect bond prices. Now, how this information relates to the current situation of the Silicon Valley Bank. Early last week, the bank was even featured in Forbes' America's Best Banks list, and by the end of the week, became the biggest U.S. bank to collapse since the 2008 crisis. This bank is now known as Silicon Valley Bank, or SVB. Even some of the greatest names in Silicon Valley, like the Shopifys and the Pinterests, have borrowed money from this 40-year-old American bank. Startup valuations and their stock prices reached record highs in 2020 and 2021. SVB also had a huge grin on his face. At the end of 2021, its deposits had increased dramatically from $62 billion at the end of 2019. In an effort to put this money to work, SVB walked straight into a trap. What's a safe and stable instrument to invest in? It thought. Of course, it turns out to be U.S. Treasury bonds and mortgage bonds. SVB did just that. Soon after, the U.S. government began raising interest rates to control inflation. Interest rates have risen from 0.25% to 4.50% today. And now a quick finance lesson from what we learned from the start of the video, that is, if one goes uphill, the other starts tumbling. Now, SVB was currently sitting on a pile of unrealized losses as startup funding was dwindling. Startups started taking their money out. On Wednesday, 8 March, SVB announced that it had sold $21 billion of bonds at a loss of $1.8 billion. Then, a significant panic trigger was activated, and a bank run was seen. When numerous depositors attempt to take their money at once because of concern that their bank won't be able to reimburse them, this is known as a bank run or run on the bank. This run-on made matters so much worse. By Thursday, 9 March, withdrawals multiplied as the stock price plummeted. And by Friday, 10 March, trading in SVB shares was paused after falling 66%. When this happened, there was no one to buy SVB stocks and SVB was unable to find buyers. Now, regulators had to step in and place SVB in receivership under the Federal Deposit Insurance Corporation. All this happened in 48 hours. Can you believe it? Well, it seems like this, but the chaos had been brewing for a while. On Sunday, 12th March 2023, the U.S. Treasury Department, Federal Reserve and Federal Deposit Insurance Corporation said that all customers would be protected and be able to fully access their funds following the bank's collapse. Now, I hope you understand to the question on how did the Silicon Valley Bank collapse occurred. For the remaining types of bonds and how can an individual invest in bonds, through which platform can we invest, the average returns bonds give, everything will be conveyed in the part 2 of this video. The current situation of Silicon Valley Bank gives us another lesson on diversifying our portfolio so as to avoid these risks. I will make a video on how can we divide our earnings and diversify so that even in market risky situation we can go out with profit. If you're interested in making